In other business news, the moderation experienced in the South African economy continues to reflect in activity recorded in the fourth quarter. That's as the latest BankservAfrica Economic Transaction Index has reached the lowest level since November of last year. Economist Elize Kruger speaks to us about the lost momentum. Thank you as always for your time, Elize. It is the lowest level in about a year. Give us the details of this reading.
Yes, the Betty actually dropped now for the fourth consecutive month, showing weakness in October particularly, and also showing that, the moderation that we've seen already in quarter three continued into quarter four. So that is really, in my view, a reflection of the ongoing economic narrative. We still have a lot of challenges. We still have our interest rates at high levels. We still have a cost of living scenario playing out that's not conducive to economic growth. And particularly in October, which was the data point that we now released. Now, if you think about fuel prices, we had significant fuel price hikes. Almost 2 rand to the litre for diesel and more than a rand to petrol. So all of those, I would say, negative economic factors in combination result in moderation in economic activity. And then especially given that the Betty is calculated in real terms. So if we adjust it for the higher inflation rate, then it also, impacts negatively on the Betty.
Elize, what picture of the South African economy does this paint then? Because lost momentum does not bode well for a trajectory that's expected to pick up anytime soon.
Yes, I think second half is definitely disappointing. First half of this year, if you recall correctly, it's been a bit better than what economists have been expecting at the beginning of the year. But second half, we have seen moderation in activity right through. And I'm thinking it is really the cumulative impact of all these factors that are now at its harshest for households and for consumers. But looking forward, if I think about 2024, we will in all probability see that interest rates start to drop in 2024. And the reason for that being that we have seen significant monetary policy tightening already, with our repo rate at a multiple year high level. And inflation is now moderating into next year compared to where we are currently. And as much as we've seen a bit of a U-turn in the last few months, we are now seeing that actually fuel prices are being cut again. So it was a short U-turn, and now we're starting to see drops in fuel prices again. So that assists us on the inflation side. So your real interest rate opens up quite significantly into next year, and that will give the Reserve Bank room to cut interest rates. So that will start to alleviate the scenario a bit in a positive way. And then on top of that, if we think about all the electricity generation projects that are in the pipeline, and some of those coming onto line, the solar that has been implemented right across the country is starting to get us to a point where there's less demand on the grid. So that would also help on the load shedding looking forward. So not to say we're not going to have it, but if we can have low levels of load shedding, that's also assisting economic activity.
I'm glad you raised inflation, the Reserve Bank, as well as expected interest rate movements. We know that the Monetary Policy Committee is meeting next week. What should we expect? Definitely not a cut as yet?
Not a cut yet. I think I do believe the Reserve Bank will keep interest rates unchanged at its current level. Because as we speak, we're going to get an inflation number next week that's going to be in the order of 5.7%. And, that is not a level that the Reserve Bank is comfortable with. And that is really driven by, as I mentioned, the higher fuel prices. But looking forward, we should see inflation dropping towards 4.8% end of this year. And into next year, we're looking at an average of around 5%. So that is indeed a good moderation compared to this year's average of 6%. So, the Reserve Bank do need to be forward-looking. And from that point of view, I do not think they would have justification to hike rates further. But given that they are conservative in their views about inflation, and also given the high risk premium that's attached to South Africa due to other reasons like our fiscal situation and so on, I do think they'll be conservative. So I expect that we will see interest rates at this level for another 3 to 6 months. But thereafter, talking second quarter next year, we should start to see drops coming through. So a bit more pain, I would say, for households and for consumers in the next 3 to 6 months. But then thereafter, I just strongly believe we'll see an alleviation of that, and that economic growth could then pick up into next year.
As a parting shot, Elize, we are fast approaching the festive season. What's expected with regards to economic transactions in that season that is also known as a silly one?
Yes, Tumisang, we actually just released our Black Friday preview as well, where we really spoke about, the trend that we've been observing over time, that November is becoming a stronger retail sales month, given the Black Friday, sales and the opportunity to purchase or do preemptive purchases at a good price. And then you get a bit of a slower December, given that there's been a lot of preemptive retail sales happening in November. So we do believe to see the same this year, that we're going to have a strong November but a weaker December. Because the economic environment is quite difficult. If you think about interest rates alone, we've seen interest rates now 125 basis points above the level where it was this time last year. And that has added, and it's a bigger claim on household budgets compared to this time last year. So we do not expect a significant bumper festive season per se, but we are thinking it's going to be a good Black Friday.
That's where we'll leave it with Elize Kruger, independent economist. They're talking to us about the latest BankservAfrica Economic Transaction Index.